Hello and welcome to Macro Pulse. This week we discuss two very significant macro developments and what it means for markets. The first is the US-Iran agreement, and the second, Kevin Warsh's first Fed meeting as the chair. Now together, these two developments may shape markets for the rest of the year. Coming into 2026, economic conditions looked favorable. Interest rates was low, the US dollar was weakening, and the price of oil was close to $60 a barrel. Then the war broke out, oil spiked to $100 a barrel, and fears of stagflation emerged, which means higher inflation and lower growth. Global inflation did rise, but global growth did not fall as much as expected. And now that the US and Iran has reached an agreement on a ceasefire and oil is flowing through the Strait of Hormuz again, can we become more constructive? Well, let's look at the agreement. It's a 60-day framework for negotiations towards a broader peace agreement. During this period, all military activity stops. Commercial ships can move through the Strait of Hormuz again. That while the US and Iran negotiate on nuclear enrichment, economic sanctions, frozen assets, and economic support. Both sides have strong incentives to reach a lasting agreement. Iran gains access to the global economy, and the US gains lower oil prices, and President Trump may win back some support, which he desperately needs with the upcoming US midterm elections in November. But the impact is far more than just lower oil prices. It also reduces inflationary pressures and ease supply chain pressures for many products outside oil, including fertilizer, aluminium, as well as helium. And it provides a better growth prospect as trade activity starts to improve and consumer activity also improves. But these improvements will come on top of a US economy that is already remarkably resilient. Economic activity in the US has remained firm, labor markets has been stable, and corporate earnings have surprised to the upside. And importantly, bond yields have also moved higher, not driven by inflation fears, but because real rates have moved higher, reflecting a more robust economy. This has also helped equities to rise. So where does this leave the Fed? Well, the Fed simply has no choice but to admit that these conditions could pose a challenge in getting inflation down towards the 2% target. While rates were left unchanged, at Kevin Warsh's first meeting as the Fed chair, the big surprise was that half of the FOMC members now sees at least one rate hike on the cards before the end of the year, and at least 1/3 of the members sees two hikes. Markets are now expecting two hikes, with the first likely at the September meeting. This is a significant shift in the macro environment for two reasons. First, the market was still expecting Fed cuts at the start of the year, and secondly, these hikes are more a result of stronger economy than the impact of fuel prices on inflation. In addition to this, Warsh delivered one of the shortest post-meeting statements on record, only 130 words, and he removed the forward guidance altogether and declined to publish his own rate projection. He also announced 5 task forces to be set up to look into first the size of the Fed's balance sheet, the Fed's communication strategy, the tools and the data used to establish the inflation outlook, the overall inflation framework, and the impact of productivity on the economy. So Kevin Warsh is signaling that there may be some reforms coming at the Fed, and that the Fed will talk less and allow macro data to do more of the talking. In the past, the Fed has always eventually hiked interest rates when nominal GDP growth remains above the policy rate. As a result, we expect Treasury yields and real rates to remain elevated, and that the US dollar could hold firm over the short term. This will be supported obviously by decent growth conditions. We do, however, recognize that the US economy is narrowing. It is more and more focused on AI-related capex and high-income consumers, and their contribution to growth has increased. And this phenomena is unsustainable over the long term. So the big question is, will the US and the global economy be able to absorb a series of rate hikes by the Fed? What does this mean for South Africa? Overall, the implications are mixed. Low oil prices should reduce inflationary pressures. It will support the consumer and improve growth prospects. But the outlook for US rate hikes could cause the rand to weaken and keep the South African Reserve Bank on a path to hike rates rather than cut rates. South Africa has entered this war period from a very strong position, and we believe that cyclical headwinds have slowed growth, but that the structural reform progress remains in place. But for cyclical outlook to improve, we need lower interest rates and we need lower inflation. Only then will the SARB be able to start talking about rate cuts again, which we think could potentially be as early as the early part of next year. Assets in SA remains exceptionally cheap, but it needs this catalyst to perform. 3 months ago, the markets were worried about stagflation. Today, the debate has shifted to lower oil prices, better growth, stronger supply chains, and a Fed that remains cautious because the US economy continues to outperform expectations. The key question for investors, we think, is no longer whether growth collapses, it is whether the US economy can remain strong in the face of potential policy rate hikes. And we think that will likely be the defining macro debate for the remainder of this year. That's all for this week. Thank you for watching.